Vested Agents presents Real Estate Action Live. Woo! Yes. We're going to do something different. Multiple guests answering a single question.
This will be a fun, fast-paced hour with amazing guests.
And that is how you're going to win all day, is to empower your people.
Too many agents trying to figure out, well, how do I get my buyer's offers accepted? It's easy. Offer the highest price. It's not rocket science.
When you're a realtor or you're doing something in real estate, you have to flip the view of what you're looking at, and you start looking at what other people are doing.
So it's really just personality based, and then having people learn the ropes in an effective way.
Focus on just being there for people and providing value.
I don't regret what I did because it really made me hustle and work hard.
Better than we've ever been. We just had our first six-figure month. That's 70K just jumped to six figures.
I'm all about like building up your knowledge base, building up your mind, building up your spirit, and just slay the day.
We're always looking for people to come along and help us with our journey as well. We can also contribute and help them develop their skills.
Thanks for having me. This is super cool.
Yeah, great. No, it's been awesome.
An honor to be here. I appreciate you guys.
Awesome. Thanks for having me.
Hi, Haley. Thank you. Good stuff.
Chris, I'm so honored to spend time with you live, teaching thousands of real estate agents how to build their brand and not be a commodity.
What's going on, everyone? We're starting a couple minutes late. Had some technical difficulties, but want to get going on this because I know this is a question on a lot of folks' mind right now, especially folks in real estate, is this whole interest rates and inflation and low inventory, high prices, and all this craziness going on in the market. What I wanted to do is go out there and find folks that have been in the market for 15 plus years, who've experienced some bumps in the road. Because basically anyone who's been in this market for less than 10 years, we really don't know a rainy day, right? It's been a good run, but a little bit of turbulence, or as I've been saying, there's clouds forming. And what does that mean? How can we best position ourselves to survey the environment, make adjustments as needed, and ultimately keep running our businesses successfully? So the first guest I have up here is Mr. Russell Simmons. He's a real estate broker, board member of the Houston Association of Realtors, and owner of Texas Area Properties. He has over 30 years of experience in both residential and commercial real estate. How you doing, Russell?
Doing good, Chris. How are you?
Doing great. So you've seen a few of these things, whether – we don't know if a recession's coming. We don't really know what's going to happen going ahead, but you've been through a few turbulent times in the market before. What are your thoughts with what we may see over the next 12, 24 months? And like, what are you doing within your business or very close people who ask you this question? What are you kind of recommending for them to navigate this?
Okay, great. Just to kind of get up to speed, got in the business in 1976. So interest rates were 18%. So I'm not a guy that's very rate sensitive. But as I've said many times before, I take what the market gives me. So, the 70s were challenging, the 80s, and, every decade since. But what I'm seeing now, the residential market is oversold. Interest rates are creeping up, so we're kind of concerned about consumer confidence. When the consumer loses confidence, then real estate really changes. So the good thing that we've got going for us is we're in Houston, Texas, and everybody wants to be here. So I'm not panicking at the moment, but whenever I see something oversold or too challenging or too many people changing the same thing, then I change directions. So if residential is difficult, I go commercial. Same goes when commercial gets too difficult, then I go back to residential. Or as you've heard me say many times before, low-hanging fruit. The phone rings, the email comes across the desk. What's the deal? If it's a good deal, regardless, commercial, country property, residential, land, whatever, you do the deal. So, but I am concerned with the inflation. I'm concerned with the consumer confidence, but not concerned enough to quit buying real estate. I mean, it might be a little bit of a slowdown. I mean, people are concerned. We came out of COVID. We've got the war right now. We've got so many things going on, and people think that they need to pull in a little bit. I understand. I don't like to be too far over my skis, but when people lose confidence, that's a great time to buy.
It definitely is. And you have a couple of different ways of looking at it. So you're an investor, but you also, I mean, at least I don't know if you do currently, but you've worked with buyers and sellers out there as well. So as from an investor, you're able to be very nimble going from residential to commercial. The landlord market, every way I really see it, it looks pretty promising, because in the event that buyers pull out, and by pull out, really what I mean is that demand, if it eases because of interest rates, because of prices or whatever, they still got to live somewhere, which means they're going to be renting. I mean, they're either not going to be upgrading their current home, which that doesn't change anything for landlords, or they're going to continue renting, which if you're a landlord, that's a good deal.
Yeah, I've had a lot of rentals for a very long time, and they're, most of them are kind of 2,000 a month plus, so good tenants, solid people. But I thought, I want to get out of these and reposition the money. So I told everybody I was going up on the rent, and hoping that a few of them would say, "Thanks, we're moving on." But they all said, "Great," and so
because they have nowhere to go.
Yeah, I'm keeping the properties, but I had a little bit of concern the last couple of years of what I was hearing with COVID and rent relief and different things like that. I didn't experience anything bad. I know some people that did, so I was wondering, well, is residential rental good for me at this stage in my career? It's not bad, but it's not something that I'm adding a whole lot of. I'm trying to concentrate on the commercial and the country property. But like you say, people have to live somewhere. What they hear on the news is what they believe. So they hear on the news that rents are going up, so they're expecting it, and I think they're comfortable paying it because they want to know where they're going to be for the next year. So if you're in residential rental, if you're in the upper part of the market, I wouldn't want to be leasing 1-bedroom apartments for, 900 to 1,000. That would be a market that would concern me now, but that's just me. Everybody's different.
And there's a lot of circumstances where it's cheaper to rent, even though rents have been, they're definitely growing quickly, and they have been over the past few years. So with prices and with interest rates now double really what they were a few months ago, could be cheaper to rent. And my wife and I, we've joked, but it's not really a joke anymore. It's like, hey, do we just cash in our equity and just go rent for a little while, and then then buy whenever an opportunity comes. But so for maybe the last 60 seconds on the commercial side, what are you seeing? What opportunities are you preparing for or working on now?
Well, it's different with commercial property. If somebody's not paying, you just kind of lock the door. We don't really have any of those issues either. But just trying to buy for value. We always have to add value somehow. We have to solve a problem. Anybody in real estate, you're really a problem solver. You do. Well, I've got a 110 acres in Flatonia, and there was not access to the back 45 acres. So I put in a low water crossing. It cost $25,000, but now I have access to 45 acres and the price doubled. So you have to see what other people can't see. You have to figure out the solution, pay for the solution, and then move forward. So I see commercial as being strong over the next 12 months. My biggest issue across the board on real estate is property taxes. That's my biggest concern.
You're not alone there.
Pardon me?
You're not alone there. Anyone who owns real estate and you got their notices over the past few weeks, they're not happy.
Yeah, well, we would pay, 1 month's rent used to cover property taxes for the year. Now it's 3.5 to 4 months in some cases. So, the entities are pricing people out of the market. As long as appreciation continues at the rate it has been over the last 10 years, that's great. But the combination of the two is kind of dangerous. Property taxes, we've got to get some relief somewhere.
Yeah.
And, the state house is talking about it. Whether they get anything accomplished, I don't know.
Awesome. Well, thank you so much, Russell. Appreciate talking to you.
Hey, good seeing you, Chris. Take care.
Take care.
Thanks. Bye-bye.
All right. And our next guest is Ricky Carruth. He's a real estate agent in Gulf Shores, Alabama. He dropped out of college to start selling real estate at 20 years old. Within 3 years, making $1 million, then lost it all in the crash. So he's got a little perspective on on how to navigate choppy water. So he ended up rebuilding his business in 2014, selling 100 houses a year as a single agent. Now he's a prominent real estate coach, mentor, educator through his Zero to Diamond program. How you doing, Ricky?
Good, man. How you doing? Good to see you.
Doing good. So with everything that's going on in the market, interest rates kind of doubling, but I mean, inventory is still low, housing's still hot, especially in a lot of the strong markets, and I'm sure it's still hot where y'all are at. And you can still get in situations where there's multiple offers and it's gone first week. I'm seeing that in the comps. It's not gonna go forever, but what are you seeing as we're kind of getting into changing winds?
Yeah, no, it's slowly slowly shifting right now, right? If you're out there trying to pick up listings, you're feeling the change happening. You know, more sellers you're talking to are a little more open to the conversation. I mean, we picked up more listings in the past 2 weeks than we have any other 2 weeks, in the past 6 months. What's more interesting is the sellers who are open to at least talking about it, whereas you can tell that they're kind of on the fence and more open to and getting closer and closer to moving forward to list their property. I think what we'll see is that, and just going back, there's just too much demand and not enough supply, even though interest rates, people don't realize it, but interest rates did knock a lot of buyers out of the market just due to debt to income ratio. But we have such a massive amount of demand out there that it's going to take a lot more to really balance things out a little bit. And that's because of inflation, of course. But I think what we're going to see is this trend continue. It's going to be real interesting to see where interest rates really go and where they kind of top out at. We're your last guest here was talking about back in the 80s when it was 18%. People keep talking about that. That was that's what they kind of compare the current inflation rate to. And but what's so different is, back then to now is the prices, right? The typical mortgage rate is like $2,500, which is up like 40% in the past 2 months at an all-time high. And it continues to push buyers out of the market. I think what we'll see as we inch closer and closer is this moment of euphoria for agents. Whereas if you've been the agent who's out there doing the things that, a lot of coaches and trainers teach you to do, which is go out there and build relationships with people in your market, build that database, remarket to these people, and really build a brand. There's going to come one day where things really bottom out and sellers are going to be calling their agent to sell. They're going to hop off the fence and say, I'm ready to sell now, because every expert that you read an article about or hear on TV, there's one thing they can all agree with, and they feel like transactions are going to be lower this year. The National Association of Realtors is calling for 2 to 4% unless, and they actually have this caveat in there that unless interest rates go up higher than expected, it could transactions could go down as much as 10%. Ian Shepherdson said that he's looking at 25% less transactions this year. So everybody kind of agrees that there's going to be less transactions. But the one key factor for real estate agents really to keep in mind as we go through this shift is that even in the worst case scenario of the predictions of, say, 25% less transactions, there's still 75% of the same amount of transactions, which is a lot, right? And so that's what we have to kind of keep our eyes on and realize that, through the ebbs and flows of the market. And I liked a lot of stuff your last guest said about not being scared to buy real estate right now. Absolutely. And you talked about rent going up. I mean, prices are higher, but at the end of the day, we're looking at our rate of return here, and rent has went way up. And when you look at that, heck, real estate in certain situations is even a better deal than it used to be from the investor standpoint, when you're buying rental properties. He talked about the low-hanging fruit going from commercial to residential when things get bad in either sector. That's very interesting, to kind of move around. To the low-hanging fruit. right now, it's kind of tough in both areas, I would think. Of course, he's talking about farmland, I believe, but I kind of work a little bit of multifamily. That's a tough market. That's almost tougher than going out and trying to get a primary home.
They're in low inventory too. I mean, they got the same
crazy
problem.
low inventory.
So, on, like you mentioned, you picked up a lot of more new listings. I'm just want to dig into the demographics there. So, and this is why I met him over the weekend. He raised like a $38 billion fund. So he's got a little bit of experience in real estate. And he was saying, like, this is the first time in pretty much everyone's life, at least if you're active in the market, it's probably the first time in your life that the mortgage rate is lower than the inflation rate. Meaning, if you've got a 2.5% mortgage and your option out there is now low fives, could end up being 6+. At that point, there's a new thought process that comes where if you don't have to sell, like, why on earth would you ever do that? So the demographics, are you seeing those folks that they were already going to upgrade, or are these people downgrading, or what are you thinking?
No, and you're absolutely right, man. The primary home market is going to continue to be tough because, like, they didn't really have anywhere to buy anyway before interest rates started coming up. So that was already an issue there, even the people that really wanted to upgrade or downgrade. So they really couldn't do that because there wasn't even any inventory. Now they're like, it's like kind of a double whammy, because now they're like, well, I'm locked into a 3.5%, or I'm locked into a 2.8 or a 3.1. Why would I go out and not only buy at these crazy high prices, but also at, twice the interest rate I have currently? So now we're at even a more retraction, I believe, of primary home owners going out there and listing properties. But it's something I've been preaching a lot about over the last couple months. And that is again, going back to the low hanging fruit that your last guest was talking about. The low hanging fruit for me right now in the residential sector is going to be your absentee owners, your second home owners, your vacation property owners.
Yep. Or they can cash in.
They can cash in. They can cash in. They can set out for a second and kind of see what happens. You're never going to sell at the very top. You're never going to buy at the very bottom. We got to be as close as it gets to the, the best time to maybe think about pulling the trigger. If you're thinking about taking some cash off the table of an investment, a second home, an absentee owner. And so I've been preaching, go after those. I'm in this secondary vacation market. We're on the beach. We sell mostly vacation properties, condos and stuff on the beach. So, I mean, one of those might've been a house. I think we listed a lot, and then the rest were condos. So I'm kind of sticking to my guns here that, moving forward and everything, that's kind of the best sector to hit are those second homes, absentee owners, vacation property owners, investment properties, the rental properties, and people like that might want to take cash off the table. And look, what are they going to do with the money, right? They're going to 1031 into, so that's an issue as well, right? Replacing that. And what are we going to do with the money? But there are listings coming up. Somebody's listing properties.
Yep.
Right. You can't just sit around and say, oh, well, nobody's listing, I'm just going to pack it in and just not try. If you want to be successful, you got to continue pushing through.
And I've been telling agents too. It's like, agent, because investors now make up to like 25% of the buyers. So understanding what investors look for, whether that's local investors or your big guys, understanding what they look for can help you transact more, both working with sellers, but also working with them as buyers. Because ultimately, the agent that has the database and knows and has these tools, it's pretty easy because you're a transactional business. An investor, there's a little bit more. They can actually take a loss. The agent doesn't really take a loss outside of maybe marketing dollars and time.
I like what your last guest said about, something comes across his desk, he's gonna do that deal. He doesn't care if it's farmland, commercial, house, whatever the case may be. Right. Same thing here. Investors come across, help them. We're just in the business of helping people, right? Figure out what they want to do, why they want to do it, and help them do it. Where people get us confused with salespeople or sales. It's not really sales, really, if you think about it. It's more service oriented. We're just trying to evaluate what someone's trying to do. Help them create a game plan around how to accomplish that, and then help them execute,
Love it. Well, thanks for coming on. Are you going to be at the shareholders event in June?
I sure will.
Okay. I'll see you there.
Yeah, man. Be
All
good.
Right, thanks. Take care.
Thanks, bud.
All right. Our next guest is Steve Dancer. He is a real estate broker, investor, developer, retired master builder with over 35 years of experience. And he's a mentor and coach, an expert at creative deal making. Are you there, Steve?
Yes, I'm here. Can you hear me?
I can hear you. I can't see you, but I can hear you.
I can't see me either. I wonder why my video is working fine here. I tested it earlier.
I'm not sure. I've had some issues with Zoom with guests before, but let's just roll with it. So we had a good conversation when I was talking to you about this show, and you had a unique perspective. 30 years in the industry, you've seen some things. So, what are your thoughts on what we can expect maybe over the next 12, 24 months?
Well, as you know, Chris, I was a custom builder for many years, a licensed custom builder. I actually flipped my first home in 1981 as a young house flipper back in those days, but I was a home builder and how to do that. So I went through all of that 70s stuff just much like Russell did. It was fun, just to say the least. Have a lot of perspective right there. Went through all those things in the 80s too. What we learned through all those years, Chris, is we learned how to make money as builders, investors, and then a little bit later on realtors in the up markets and the down markets, because they're coming. And you're right, boy, the last 5 or 10 years for new realtors and or investors, there's been a lot of gravy, low-hanging fruit. But what you find out is in the down markets, and this is what you're going to learn. People are going to freak out for a few minutes. Don't freak out. Just go learn some new techniques. And during those down markets, man, that's where the low-hanging fruit really is. When you learn how to make real money in the down markets, Chris, there are some people listening today that are future millionaires. And I hope what I have to say will help them get there a lot quicker, right?
Yeah, I mean, because when things are good, it doesn't really encourage development because things can be easy. Although, with low inventory, that's definitely a challenge for agents and investors. But when things are tough, whether that's market or just your business, you have to get creative. You got to get to work and figure out how you're going to solve problems and provide better solutions to people. So it seems like that is that what you're referring to on how folks are they actually they can look at it as this is an opportunity for them to go from A, not to B, but like A to E.
That's right. I mean, we experienced the 18% interest rates. We experienced that. And man, there was blood in the streets as far as new builders go. Rows and rows of homes, savings and loan companies were shutting down. They went bust. We experienced all that. This is different today. We're not seeing homes upside down like we did during subprime. Subprime, the homes are just upside down. There were a lot of people that shouldn't have been buying homes that were sold homes. They should have been renting until they saved a few more dollars to qualify for a real loan, not the loans that were being handed out so easily back in those days. It's a little bit different now, although some of the loans have changed and gotten a little easier, but not nearly like it was just before subprime. So in that time, there was no equity. We had to do deals in those days where there was no equity. So we focused on short sales where we could beat the lenders down and create equity through that sort of thing. Did well over 400 short sales in about 7 years of doing short sales. We created an activity that made that work. With short sales comes every other type of deal you can possibly imagine as a realtor and as an investor. Every kind of creative deal that you can imagine and use legally and ethically. Hello, please underline that, right, Chris? Legally and ethically, do it the right way. And oftentimes legal and ethically means you have to disclose correctly, whether you're a realtor or not. I got news for everybody out there, whether you're a realtor or not, and I'm a broker. If you don't disclose, man, whether you're a realtor, broker, or just an investor, hello, you got problems. I mean, you got serious problems out there. So do it the right way, disclose, use the right documents, get a good attorney, right? A good real estate attorney, show you how to do it right? Because I've got 2 good ones and they're too darn expensive, but I pay them, right? I pay them well because I make good money and they help support that activity.
Yeah.
But we're seeing that these interest rates are going to go. What we saw back in the day, Chris, we saw the 18% stuff. We saw inflation go well over 10%. As you know, we're not far from that now, as you know. And so,
yeah, and when we had our conversation, I put out a poll just to see what other folks had, and there were a few, and it was basically, hey, where do you think it's going to top out at? 6, 7, 8, 9, and 10. The majority is around the 6 and 7s, but there were some 9s and 10s votes out there. It'll definitely be interesting. Now, one thing that I've been saying, actually, I've said this for years, way before inflation ever kicked in, is the folks that really make the most in this low, like free money environment. By free money, the 4%, 3%, 2%, era that we were living in. The ones that really make the most money are those that built a portfolio with long-term fixed at those rates, and then end up owners financing them when interest rates get up into the 7, 8, 9, 10, era. Because ultimately when the interest rates get there, then they're owners financing for 10, 11, 12, 13, 14. And I mean, those folks will probably end up making 10 times the original purchase price of their house. But there's also this other little spot. And I just bring this up since you're keen on creative financing. Being able to buy a house now with using short-term financing, or say interest rates get to 6, short-term financing may go 12 to 14. Being able to negotiate either owner's financing or subject to existing financing on a house that has 2.5, that's gotten a lot of value. What are your thoughts there?
There's some tremendous deals out there, and you're right on the money. I call it creative deal making 101, creative deal making 101, and mastering OPM, other people's money. There's 2.5%, 3% rates out there all day long. Subject to deals out the wazoo. Man is at an area we've been working the last 2 years. We kind of pulled back about 1.5 to 2 years ago on our agency business. We're still doing it. We're still just sold a listing the other day. Okay. We're still doing it, but we're focused more on the investing side, because there's some cheap money out there on the creative deal making side. We can get a loan over there. It's 2.5%, 3%, right? And then we can do either a version of a wrap or a version of subject to or a deed assumption. Many different creative ways we do it ethically and legally. And holy cow, we can get an interest rate for a short-term seller finance deal, maybe 7.5%. Think about that spread on that right there, right?
Yeah, plus points. It won't surprise you, but my very first deal was owners. It was subject to it was the third deal. The first deal I held subject to 9.5%. And I was happy to get that deal. We ended up renting it out, but 9.5%. That was 2015 or no, 2005. I'm not sure where the mortgage was originated, somewhere in the 90s. But
in today's market, the number one way we're creating notes, and I love creating notes, and the number one way we're doing it, because you can push the price. For example, if it's a home that's going to sell for $350, we push the price up to $375, $385, $390. It may not appraise for that, but the buyer, if they want to buy it and they're doing conventional financing, let's say it appraises for $355 and we are selling it at $385. And there's got to be a negotiation there. And we've got that home optioned, exclusive right to purchase it with all the documents filed with the courthouse, right? There's a $30,000 spread there. They're not going to do that, and the seller's not going to take anything less, right? And so we simply do a $30,000 second lien carryback note ourselves, a note created out of whole cloth. And I'm telling you, remember the old movie that said, "You got mail," right? You got mail.
Mm-hmm. Yeah.
Now on my phone, now you can set up a phone from your bank. When I get this ping on my phone, it's no longer "you got mail," it's "you got money." Okay, that's the way it's got to be. So we create a note out of that difference right there. While we have equitable interest in the property, we have the legal right to do that. We got a $30,000 note. Do it out there for about 10 years. They may pay it off in 5. But man, you got $200, $300, $400 a month coming in out of something you didn't take out of your pocket to create a note. That's creative deal making. You want to become a millionaire? Go do a bunch of those. That's the way to go. Plus, how about making another $20,000 or $30,000 on the option spread when you sell it?
Yeah. Anyone who's interested in notes or cash flow, I think you got their mouth watering right now.
Yeah.
Well, thank you so much, Steve. We'll definitely talk again, because I know pretty much everything you said is going to be very, very relevant. It's always relevant, but I think even more relevant in this coming market, where you might have to get a little bit more creative to make deals work depending on what kind of shakes out in the market. So
yeah, I can't wait for 10% interest rates. I can't wait. Right. With their guys. Let's go make $1 million. Let's go make $1 million, Chris.
Absolutely. Thank you, Steve.
Thank you. Bye-bye.
Bye. All right. Next guest we have is Daryl Dyke. Daryl is an entrepreneur and real estate finance expert with 26 years of experience. He owns Noble Mortgage, an investment lender that offers both hard money and conventional financing. In 2021, so last year, he actually founded the Legacy Insurance Advisors. How you doing, Daryl?
I'm good. How you doing, Chris?
Doing good. So for this hour, we've been talking about the housing market, possible looming recession sometime in the next 12, 24 months, interest rates doubling. What are your thoughts there?
Man, that sounds like a lot of bad news.
It's news, but yeah, it's definitely, it's spun as bad, but it's news. What are your thoughts? I don't know. Is that good or is that bad?
I mean, inflation right now is the enemy. So that's what they have to get a handle on, which is obviously what is pushing up interest rates right now. So interest rates have slowly been pushing up, as far as how that affects real estate. I think it's going to slow the market down a little bit. It's going to push some buyers out of being able to afford anything, which is already an issue. It's also going to downgrade some buyers from maybe looking at a certain price range of home. What I always look at as a lender, and especially as a hard money lender, is that move up market. That move up market is typically, I consider, like 600,000 to $1 million. And that's someone who has done well financially over the last couple of years, and now they're looking to upgrade from a $300,000 or $400,000 house to a $600,000, $800,000, $900,000 house. So that market is always the soft market in my mind whenever the rates move up. So I think it's going to affect that market a lot. Anything over $1.5 million or so, it doesn't really affect it that much. But lower income also, we have a major affordability problem across the nation and all across Texas right now. And rates moving up is certainly not going to help that, but it will help inventory. Inventory has been a major problem. Houston is, I think, 1.4 months, 1.3 months right now. So that's always an issue.
So what do you think about this? I've been saying we've had 10 years of like it could be, I don't know if this is true, but definitely over the last 100 years, this has been like the best time to ever be in real estate.
Yeah, absolutely.
And now it comes off the cuff of the worst time to be in real estate, which was 2008. But so we got 10 years of really, really good times. So over the next few years, I mean, with inflation, because I've read different reports, even from Fed managers, different regional managers are saying like this is crazy. The Fed's not doing enough. Like they need to be doing like 3 times what they're doing, which is insane to think about. Do we have maybe 10 years of it, even if it doesn't, we don't actually have a recessionary pricing, which I don't really see. I see some people talking about that. Do we have 10 years of flatline, like to catch up, or maybe 5 years of flatline, very slow growth? By flatline, I just mean 0 to 5% growth versus 20 plus.
Yeah, I mean, I think it's certainly going to affect the appreciation. Look at especially the last 3 years, the appreciation has been insane. Especially from an investing standpoint, it's dangerous. I mean, it's good for the market. It's dangerous for investors because it turns investors into lazy investors. And what it does is it allows you to make a mistake on a flip or whatever it is you're doing and still make money.
The market will help you out.
Yeah, and so it also makes investors more aggressive because now they're betting on the come. They're betting on that appreciation. So I think it's going to slow down a lot of that money going into the market. As far as appreciation, I think it will slow it down. Inventory has been one of the big factors that has caused appreciation to elevate so rapidly. Mm-hmm. So I could certainly see a flat line. You could even see some markets moving down. Maybe some outlying markets that have been affected by the low inventory. You have a lot of investors that have moved into, maybe not in the major metropolitan areas, some of the smaller counties outside these major metropolitans, and even maybe some of the suburbs of major metropolitan cities like Houston and Austin and Dallas and so forth. I think those typically get affected first. Inner loop areas, inner city areas, you typically don't see a lot of depreciation. Maybe we'll see slower appreciation, but I don't see anything as far as a rapid depreciation.
Yeah, and ultimately, I think cash flow becomes even more important because if you're not going to be making it on appreciation, which, I mean, you have two. You've got cash flow, and then you got appreciation. That's ultimately, I mean, excluding equity gain and tax benefits. Those are really the two main ways you're making money as an investor or as a homeowner. It's more, I guess, savings versus rent, and then appreciation. So that means cash flow. Like if you're not buying for cash flow, you're putting yourself at real risk in the event of appreciation flatlining or even receding a little bit.
Yeah, I mean, if typically you're betting on one or the other. You very rarely do you get both appreciation, at least rapid appreciation and cash flow. But I think a lot of investors have seen that the last 3-4 years.
So, yeah, it's been really glorious times for landlords. It's been
absolutely
tough for a lot of folks, but
yeah, the value of their properties have gone up a lot, and they're getting good cash flow. I think the cash flow is really what's going to get pinched the most in the coming months, because as the rates are moving up, the rents haven't been able to move up quite as rapidly. I think we're going to see a lot of rent increases in the future, but certain markets are not going to be able to keep up with that because you have affordability issues. So I think if you're an appreciation investor, you're always going to be fine because the market's always going to eventually appreciate over time. Cash flow, you're going to have to be a little more selective about which market you're in.
Yeah, some of the advice and let me know what your thoughts there here. For investors, I've been telling folks, like, look, if you're buying to flip, you need to be a bit more cautious. Like, you need to be very, very stingy on your numbers, and maybe even add for some, X factor that you don't know, because the market has been forgiving for bad projects. But if you're buying long term, the worst thing that can happen is you got to put a little bit more money down, and that'll cover your cash flow problem. Because typically rents you don't necessarily see a receding in rents. You definitely can. It's not impossible, but at least in, maybe not in the New York area and those kind of areas. But usually, as long like over time, it fixes itself. It will appreciate. Rents will go up. So it's mainly just your initial debt service that maybe you just got to put a little bit more money down to make sure it cash flows.
Yeah, that's one way to do it. And you also, when you're looking at a rising interest rate environment, or when you're possibly looking at a recession, if you're flipping houses, you need to be thinking about multiple exit strategies. Multiple exit strategies can help out a lot. You have to have that mindset. Maybe you're not able to flip that house for what you thought you were, and maybe it ends up on the market a little bit longer. So you need to figure out what else you can do with it. Do you just keep it and rent it? Do you own or finance it? I mean, there's all kinds of different ways to create cash flow. And that's what you're going to have to do if we do hit a recession and the real estate market takes a hit.
Which is precisely why I tell folks that are buying Airbnbs, short-term rentals, like, look, you're buying this and that's your only exit strategy because you're paying retail and it does well as an Airbnb. Great. But your problem is if it doesn't cash flow long-term, because maybe a COVID situation happens where you can't short-term rent it, or you get saturated and the short-term rates, plummet, you're in a bad spot. Now your only exit is to sell it. And can you sell it for a profit?
Yeah, if Airbnb is your only exit and you're banking on that type of cash flow, because you make a lot more money on Airbnb, if you need that type of cash flow, that's certainly a dangerous spot to be in. Multiple exit strategies are everything. You look at them. I started my company in 2003, so I went through the Great Recession of 08 and 09, and as a hard-made lender, you get foreclosures from time to time. I don't get that many. I get between 0 and 3 a month.
Yeah.
0 and 3 a year. But in 08 and 09, we took back a lot of properties, and so some of them, well, quite frankly, we couldn't even sell. There was no buyers in those markets. And so I had to get creative. We always try to sell it immediately. We're not in the market of holding real estate. But some of these houses that we had loans on, unless I wanted to just take a beating, I had to figure something else out. So I owner financed some, I rented some, and I held on to them for several years and eventually liquidated several in, I think, 2017, 18. And then I liquidated actually the last two last year. So you just hold it. If you're upside down,
did that turn them all around?
What's that?
Did that turn them all around?
Oh yeah, absolutely. I mean, you sit on a piece of real estate, eventually the appreciation is going to catch up. So
it'll always catch up with your mistakes. I mean, really, the only X factor is if it's like just a money pit because it's so old.
Yes.
But I guess then eventually land prices, but that's a different equation.
Yeah.
No, we've done the same thing. Where
we did fine on all the houses that we sold. We just had to wait. Matter of fact, we did good on the last two I sold. I didn't sell them because they were such good rental houses.
Yeah, 100%.
At the time, I was buried in them. I couldn't get out of them. I was like, "When I'm just going to rent these houses." We rented them out, and they sold for 2.5 times what we had into them last year. So it worked out good.
Okay, and if you have a couple more minutes, just want to see. So where do you think interest rates are going to go? Because I did a poll on this. And there were some people voting the 10s, most were in the 6s and 7s. But where are you thinking? Maybe like 30 seconds there.
Yeah, I don't hope we don't get to the 10s. It's very hard to predict interest rates. But right now we're right around 5 on a primary, 6 on a 6.5, something like that on investment property. I could easily see primary rates going up to 6 or 7. Maybe even mid 7s. Investment rates maybe 8 or 9 sometime. Unless they get a handle on inflation. As long as inflation is where it is, they're going to keep raising rates. They have to. That's the only way to combat it.
Yeah, absolutely. Thank you so much, Daryl. Look forward to connecting with you soon.
Yeah, you too. Good to see you, Chris.
All right. Our next guest is Mr. Blake Yarborough. He is an investor, certified financial planner, real estate broker, mortgage broker, hard money lender, and he's got over 20 years of experience. He owns Capital Concepts, an investment lender that provides both short-term and long-term loan services. How you doing, Blake? Can you hear me? Hey, Blake, can you hear me? We may have some technical issues. All right, I'm going to bring up Rich.
Hey,
Rich, we're having some technical issues, so I'm going to bring you up if you're good.
I'm ready. What's going on?
So, Rich, he's a second-time guest, former naval officer and CEO of Renters Warehouse, Houston, which is the most successful Renters Warehouse franchise in the nation. He's also the oldest home builders franchise, and he's flipped, some 1,500 houses. You got a little bit of experience. Looks like you're enjoying the outside. Can you hear me all right?
I can. I was sitting by the pool and it started raining. I had to get on the porch.
All right. So, we've been talking about the housing market and everything else going on in the market, low inventory, recession talk looming. What are your thoughts on what we're going to be experiencing over the next 12, 24 months?
I had to speak at a lunch and learn the other day, and so I kind of focused on what does Wall Street know that we don't know, right? Because you look at they don't know everything, but when you got some of the most highly educated and finger on the pulse of the economy people in the world, and all they're doing is raising billions of dollars to buy more single family rentals in the Sun Belt, that tells you something, right? They are looking at it and seeing what I've seen, and a lot of people in Houston that talk on social media or talk at events and that have a lot of experience in buying and selling and fixing and renting and you name it, is we have a real housing shortage in America. I mean, an affordable housing shortage. It's not 2007-08 when we had a bunch of irresponsible lending and a bunch of foreclosures and a bunch of extra inventory. We truly are in a shortage situation, and I don't see it getting better. I mean, if you look at, how many houses were built in the last year versus how many houses were built in the 1950s, it's about the same. Well, yeah. we need more houses than we did back then, and we're not building them. And the ones that are getting built aren't $140,000.
No, really sub 200,000. It's pretty much extinct unless it's
darn near gone. Yep.
Yeah, unless it's maybe a tiny home or a modular home, and maybe that that's what becomes the first time home buyer home.
Oh yeah,
I don't know.
Mobile homes. hell, you can't buy a mobile home for what you could buy it for a year or two ago. Man, damn near doubled to buy, say a new one. And
100%. I've seen them now, especially if it comes with an acre or two. 300 easy.
It's insane.
So from an investor standpoint, you alluded on to, hey, look what the big guys are doing. There's a reason why they're literally trying to gobble up as much real estate as possible. They have more information than we do. Now you can like that or not. You can like those companies or not, but at the end of the day, that's what they're doing. So you're saying, hey, I'm watching them and I'm trying to see, hey, how can I do the same thing? You there? Okay.
I'm here if you can hear me.
Yeah, I can hear you.
We've been in that mode since day one. I don't see a bubble coming. I used to argue on social media quite a bit. Now I just kind of throw up my 2 cents in once in a while. And someone said something about a bubble. I said, except it's not a bubble. And don't get me wrong. I don't know anything, so I wouldn't listen to me for investment advice anyway. But I don't see a bubble coming just because it's a true shortage. I don't see 20% appreciation for the next 5 years per year like we had last year. But if you had 20% appreciation and you put 20% down on a house, you just doubled your money in 1 year, right?
Yeah.
So you think about, people don't think like that. And the commercial real estate industry has been thinking like that for decades, is buy something, make a little bit of money on it, maybe, if you can, but really they don't care about cash flow. They care about building wealth and appreciation. And that's what we've, over the last 5 years learned, that's what you really need to focus on.
Yeah. Wealth preservation. Yeah. Wealth preservation through staving off inflation, also substantial tax benefits. And then you've got the appreciation side and cash flow side, which is the wealth creation. Yep. You got preservation and creation, and the rich understand this.
Yeah, it's interesting. That's a good point.
Yeah, go ahead.
Saying that's a good point about the preservation. Is you got a place to put your money, and you don't. If you're in the stock market, you know what's happened over the last 60, 90 days. It's pitiful, and it's very volatile. Very risky, very volatile.
If you have $1 million in your bank account last year, you lost $75,000, which is, that's probably somewhere around the average income of America. So if you had $1 million in your bank account, now it's $75,000 less. So, if you don't have somewhere to put it, you just buy something, you pay cash for it.
Well, and I would argue that's a conservative number. I think the inflation rate's higher than that. The true rate is higher than what the government's putting out. But, that's the hard assets are where you put your money when in inflationary times. And we got it going on. So hard assets are the place to be, because if, like you said, if you got cash, it's worth less every day. But if you have an asset and dollars become less valuable, the asset becomes more valuable. And if you can leverage to buy that asset, you multiply your return.
Love it. Love it. Well, every time I talk to you, you seem like you have this oasis in the background. So life must be good.
Well, I don't know about that. You ought to see the overhead of this place.
All right. It was nice talking with you, Rich.
You too. I got something for you. So holler at me when you have some time.
Yeah, sure thing.
I got a new idea.
Awesome. All right. Take care.
All right. Take care, guys.
Bye.
Thanks for having me. Bye-bye.
Thanks. All right. We got Mr. Blake Yarborough back. How you doing, Blake?
Hey, I'm doing well.
We're good. I can hear you.
Yeah.
You weren't the only one today. We had a few different tech issues, but we're plowing along through. So you're very experienced in real estate as an investor, as a lender, as a broker. So you've got a unique, balanced experience across multiple different sides of the real estate market. What are you thinking about? Because interest rates, they've doubled really over the past few months. Still have low inventory. We still have high demand. We're still in certain markets having multiple offer situations, or if it, at least the low inventory, like I think in Houston alone, it's like what 1.5 or something. So what are you thinking is going to turn out over the next 12, 24 months?
A normal market's about 6 months of inventory, right?
Mm-hmm.
So we got a lot of slowing down before we get there. So I saw something they were talking about. Dallas is starting to talk about not allowing investors to buy properties.
I saw that. I don't know how they pull that off in Texas, but I saw that. And that came off Canada. So Canada banned foreign investors for 2 years.
And I think California was talking about it, and now I guess don't count my Texas. But now we got. I mean, the rates are still historically low. You know, everybody's complaining now getting 5, touching 6s, but I mean that's still a historically low rate. We're going to be,
and by historically low, what you're referring to is you pull out 30 years of rates, and it looks like a stairs going downward all the way to the rock bottom, which was 6 months ago, 4 months ago, which now we're still maybe one step up from that.
So, I mean, what Richard was talking about, a shortage of housing, there's always been, you listen to these economists, they're talking about there's been a shortage of developmental loans and things like that since the 80s. We just haven't been keeping up with the demand of housing. And so that's, some of those economists think that we've still got a shortage to fill with more housing. So, I still have a family. I like the liquidity with houses. So if something happens, I can still always put a rebuyer, rehab, owner finance, whatever it may be. The amazing we in prices as it's been crazy, but it's been good if you own some assets. You can't expect the low rates and this appreciation to continue. Eventually, slow down. And with these increases in rates, I think they're trying to slow it down.
Well, what are your thoughts here? So I've heard a couple different contrarian views on the low inventory. I haven't dug deep into the data because it wasn't readily available. But essentially what they were saying is we don't have shortage of inventory. What we do is have consolidation of inventory that investors own, meaning single family, which investors have been buying that up, in larger percentages over the last, 5-8 years. But then you got the multifamily side too, which the development on multifamily has really been driving the development of all residential. It's mainly been multifamily because we haven't been keeping up on the single family side. So their argument is we actually have ample inventory. It's all tied up. It's not on the market. And I don't know if you have any data or if you've seen anything that kind of validates that or any commentary on that.
When you say all tied up, you mean
it's off market? Like they're not selling right now. So before COVID, there was still a shortage where I think in Houston, it was around 3 or slightly below 3 months of inventory, which is still below the 6 months. And then COVID happened, it dropped below 1 month, and it's been inching its way back up, but still below pre-COVID levels.
Yeah. If the market starts slowing down, people might be more apt to selling, right? Right now, they're seeing the appreciation and everything going up, and you don't want to miss the boat, right? So I don't, if there was plenty of everything, then there would be plenty of stuff for other people to buy, I guess is my thing. As y'all touched on, the below medium price range houses, heck, the medium price range has gone up. I don't know exactly, but it seems like it's gone up almost 100,000 in the last couple of years.
Yeah, it's over 350 now, right? In Houston,
it just doesn't seem that long ago. It was 260 or so.
Yeah.
I mean, from investment, I don't think you can get hurt by it. We'll slow down after every inflationary period, there's a recessionary period. And they dumped so much money into the economy for so long to keep it afloat. We bull market, if you will, or prosperity, or whatever you want to call it, for longer than we normally have. You know, they've been pushing it through. You got the blip for COVID, but they have to if we have an adult in the office, whichever party's in there, we have to put the brakes on inflation. And to me, nationally, it's not going to feel good, but we're in Texas, so I kind of like, I kind of go both sides, right? I have the little angel said, oh, we have the population, we're still affordable place to live, this, that, together. The other side of the coin, I'm like, well, we've run up a lot faster than we did in 08 and 09. So maybe if fall, we might have more to fall than we did back then. So I'm kind of conflicted, and I think now's the time. If you're going to sell anything, sell the stuff you don't want. Sorry.
Yeah. So, I mean, so if you don't have to move, if it is that secondary house, go ahead and cash in. You're okay cashing in. Now, if you're worried about what you're going to do with the money, then maybe you hold on to it, presuming you don't need it. That's what I've been told. People ask, hey, should I sell now? I'm like, look, do you need the money? No. Well, then do you have someplace you're going to put the money afterwards? No. Don't sell. Like, if you need the money, sure, cash in. If you have another place to put the money, another investment opportunity or whatever, another house.
You need the money to do a cash out, right? And you don't have the tax.
Yeah, 100%. Yeah, and then that's tax-free.
Right. So, there's that, and you still have the asset, so you still have the investment.
Yeah, we did that a couple times last year.
Yeah.
We actually were going to sell a house, and then when I went back to check the comps, I'm like, holy cow, we can refinance at the same price I thought I would be able to sell it at.
I pulled out $1.7 million, 50-something properties just under a year and a half ago, and I'm putting them on 15, 20-year notes, so that's paying down some. But I could darn near, not quite all the way, but I could pull most of that back out again already, just because the appreciation is crazy.
Yeah.
But, now the real estate, or I say single family, the reason why they're buying, but I think it's a number one asset class to be in moving forward, and that's why they're gobbling it up. Plus, it's hard assets, and instead of a paper asset like the stock market. So if you got cash flow in real estate, I think it's a good position to be in. I mean, that's why they're buying it up. The hedge fund.
Yep, and seems to be the consensus of the most of the guests. So, well, I appreciate it, Blake. You've got a lot of experience, so I'm sure some folks got a lot out of that, and look forward to seeing you at one of the events again here soon.
Yeah, we're past COVID now. We can see each other, right?
Yeah. They were actually doing hugs at an event I was at last time. It was like, kind of felt a little weird, but once you get over that, yeah, we're all right.
Well, I'm not wearing my mask while I'm on a video call. All right, buddy.
All right. Thanks. Take care.
See ya. Bye.
All right. Thanks. Another show in the books. We have a live event coming up here soon. So if you're not on our email list, go to investedagents.com and you can click on the community, get set up in our investor community, and of course, stay up to date on upcoming events, because we do have a couple different live events coming up in mid-May. So stay tuned on that. Otherwise, drop your comments. Let me know what you thought. Any questions? Are you bullish, bearish on the market? And I'll talk to you next time.